Why banks fear people. With $100,000 saved. Walk into a bank with $500 in your account and you're just another customer. Walk in with $100,000 and suddenly everything changes. The fees disappear. The service improves. Someone knows your name. You get access to premium benefits that didn't exist 5 minutes ago. Same bank, same building, same person, different treatment. Most people assume that's because banks respect wealthy customers. That's not true. Banks don't fear people with $100,000 because they're rich. They fear them because they're no longer profitable. And once you understand why, you'll never look at your savings account the same way again. The customer banks secretly love. Let's start with a question. Who do you think is more valuable to a bank? The customer with $100,000 sitting safely in savings, or the customer living paycheck to paycheck? Most people choose the first one. They're wrong. The customer banks love most is the one who's always a little short, the person who occasionally overdrafts, the person carrying a credit card balance, the person paying monthly account fees, the person borrowing money instead of owning it. Why? Because that's where the profits come from. Banks make billions every year from overdraft fees, credit card interest, maintenance charges, and lending products. The less financial breathing room you have, the more opportunities the system has to charge you. Think about it. If your account drops below a minimum balance requirement, you pay a fee. If you miss a payment, you pay a fee. If you borrow money, you pay interest. If you carry debt, you pay even more interest. Every financial mistake creates revenue for someone else, and that someone is usually a bank. The business model nobody talks about. Most people think banks make money by holding deposits. They don't. Deposits are simply raw material. When you put money into a bank account, that money doesn't sit there doing nothing. The bank uses it, it lends it, it invests it. It turns your money into its profits. Imagine you deposit $100,000. The bank might pay you a few $100s per year in interest. Then it turns around and lends that same money out through mortgages, car loans, business loans, and credit lines. The spread between what they pay you and what they earn from lending is where the magic happens. Your money works for them. The difference is they keep most of the reward. That's why banks love deposits. But here's where things get interesting. At a certain point, a saver becomes less profitable than a borrower, and that's where the relationship changes. The $100,000 threshold. For most people, $100,000 feels like an arbitrary number, a nice milestone, a round number, a psychological goal. But in the financial world, it's much more than that. It's a line. A dividing line between two completely different financial lives. Below that line, your income is doing most of the work. Above that line, your money starts working alongside you. That's the moment many people stop renting money and start owning capital. And banks know exactly when that transition happens, because that's when customers become harder to control. The power of compounding. Let's imagine someone invests $500 every month. Nothing extraordinary. No lottery tickets, no crypto moonshots, just steady investing. Assume a long-term annual return of 7%. At first, progress feels painfully slow. Month after month, year after year, most of the growth comes from new contributions. You're doing all the heavy lifting. Then, something remarkable happens. Around the 6-figure mark, the money itself begins generating meaningful growth. The investment account starts contributing almost as much as the person funding it. That's when wealth creation begins accelerating, and acceleration changes everything. Because once your money starts earning money, the system works differently. The game shifts, the rules change, the bank notices. Why banks prefer borrowers. Let's compare two people. Alex and Sarah. Alex has $3,000 in savings but carries a credit card balance. Sarah has $100,000 invested and no debt. Who generates more profit for the bank? Alex. Every month, Alex pays interest. Every year, Alex might trigger fees. Every financial emergency creates another opportunity for the bank to earn revenue. Sarah does the opposite. She avoids debt. She avoids fees. She reads the fine print. She moves money when better opportunities appear. She's financially independent enough to say no. And banks don't love customers who say no. They love customers who need them. That's why the person with less money often ends up paying more. Not because they're irresponsible, because they're trapped in the expensive side of the system. The real reason service improves. Have you ever noticed how banks suddenly become friendlier when your balance gets bigger? That's not a coincidence. It's retention. The moment you accumulate serious savings, other financial institutions want your business. Investment firms want your assets. Brokerages want your accounts. Private banks want your deposits. You're no longer a captive customer. You're a customer who can leave. And that's what changes everything. The bank assigns you a relationship manager. The fees disappear, the perks appear, the phone gets answered faster. Not because they suddenly like you, because they don't want to lose you. Big difference. Wealth creates options. The biggest advantage of having $100,000 saved isn't the interest, it's the choices. People often focus on returns. The truly valuable thing is flexibility. Imagine your car breaks down tomorrow. A person living paycheck to paycheck experiences panic. Someone with a substantial emergency fund experiences inconvenience. Same event, completely different emotional experience. The same principle applies everywhere. A bad boss, a toxic workplace, a surprise expense, an economic downturn. Money doesn't eliminate problems, it changes your response to them. Instead of reacting from fear, you can respond from patience. And patience is one of the most powerful financial advantages in the world. The hidden tax of being broke. One of the cruelest realities of modern finance is that being broke is expensive. You pay higher interest rates. You pay more fees. You have fewer options. You make decisions under pressure. The person with no cushion often pays the highest price for everything. Meanwhile, the person with savings gets discounts, rewards, better rates, and special treatment. It's completely backwards. The people who need help the most often receive the least. The people who need help the least often receive the most. That's not an accident. That's how the system is designed. And $100,000 is often the point where you begin escaping that cycle. Why banks fear financial independence. Let's be clear. Banks don't fear wealthy savers because they're dangerous. They fear them because they're free. And freedom is incredibly difficult to profit from. Think about the ideal banking customer. Someone carrying a credit card balance, someone financing their car, someone paying interest on a mortgage, someone who occasionally overdrafts, someone who needs the bank. Now compare that to a person with $100,000 saved. They don't panic when an emergency hits. They don't need payday loans. They don't need to carry expensive debt. They don't have to say yes to every financial product being pushed across the desk. Most importantly, they can walk away. And that's what changes everything. Because the moment you have options, you become harder to monetize. The bank can no longer rely on fees. It can no longer rely on interest payments. It can no longer assume you'll stay simply because you have no alternative. For years, the relationship was one-sided. You needed them. Now they need you. That's why the tone changes. The hold times get shorter. The fees mysteriously disappear. The relationship manager suddenly wants to schedule a meeting. The institution that barely noticed you at $500 suddenly knows your first name at $100,000, not because you've become more important as a person, because you've become more valuable as an asset. Your deposits can leave. Your investments can move. Your loyalty is no longer guaranteed. And competition for financially independent people is fierce. Banks understand something most people don't. A customer with savings is profitable. A customer with financial freedom is dangerous. Because financially free people ask questions. They compare rates. They negotiate. They read the fine print. And when they find a better deal, they leave. The bank isn't afraid you'll take its money. It's afraid you'll stop giving it yours. That's the real reason everything changes when you cross 6 figures. You haven't entered a higher class of customer. You've escaped the class of customer the system was designed to profit from. And once you see that, you'll never look at a premium banking relationship the same way again. The bigger lesson. This isn't really a story about banks. It's a story about leverage. At $500, life pushes you around. At $100,000, you start pushing back. You don't need permission. You don't need perfect timing. You don't need extraordinary intelligence. You simply need enough financial breathing room to stop making decisions from desperation. That's the real power of 6 figures, not the status, not the prestige, not the number itself, the freedom, the ability to choose, the ability to wait, the ability to walk away. And those are the exact qualities that make someone difficult for the financial system to profit from. Which is why banks don't celebrate when customers reach $100,000. They adapt, because the moment you cross that line, you're no longer playing the same game. You're finally starting to own it. If you enjoyed this video, make sure to like, subscribe, and turn on notifications for more deep dives into money, wealth, and financial psychology. And let me know in the comments. What's harder, earning your first $100,000 or keeping it once you've got it?